So what's better for stocks? Good economic data or bad? One would think the first. But for the past couple of years, stock markets have rallied on bad economic news. That's because it meant the Federal Reserve would continue to pump cheap money into the economy. And any signs of positive indicators, like strong hiring, would actually send stocks lower. That's because people thought the Fed would remove that support from the economy. Now, the dynamic might be changing. Yes, the stock market shrugged off the weak jobs report in March, but here's why the rest of the year might be different. For one, the Fed will probably raise rates later this year, and one jobs report that's negative probably is not going to change that course. Two, the employment number wasn't the only soft indicator of the economy. We had weak manufacturing activity and weak consumer spending. Now, those two dynamics might actually play out in corporate earnings when that season unofficially kicks off later this week. Three, the U.S. economy is actually fighting the downside of a very strong dollar, which means American products are more expensive overseas. Now, I just gave you the very pessimistic case for the U.S. economy and for the stock market. But most optimists would point to the fact that the first quarter has been a rough one for the last 5 years, and the rest of the year, the second, third, and fourth quarters, end up turning out pretty well.